Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from, as usual, a beautiful Denver, Colorado. Today, I am running solo for all of you, but you can say hey to Brent Moores in the chat. He's going to be getting to comments and questions I'm unable to during our discussion this morning. Please feel free to post in the chat for the duration of the show. We will go about 45 minutes or so today with all of you. We have plenty to address. Before we get into that, though, please remember to follow Brent and me on X. Brent Moores, CS, and Kevin Horner, CS. We always appreciate a follow there. On X, that is absolutely the best way to follow up with your coaches outside of the classes that we provide for you here on the channel. Couple of key notes. Number one, when we're on X, remember, we're never going to reach out to you directly. We will happily reply to your questions, your comments, etc., but never expect to hear from us on a reach out or proactive basis. If you are hearing from people claiming to be associated with Schwab, very likely they are not us. So please validate your following of your Schwab coaches. Make sure those addresses are good. And please report any imposters you may come across. Additionally, let's remind you to follow us on the channel here. Make sure you're subscribed to the channel. Let's get to our disclosures, and then we can move into today's conversation. Like I said, lots to get to. So remember that our discussion is entirely informational and educational for you. We do not make recommendations. We do not make endorsements of any particular approach to trading the market. What we do here, though, is discuss technical analysis. We try to provide you with some concepts and strategies traders might choose to employ in their own trading processes. We discourage you, however, from considering technical analysis as the only means of your decision making. So simply put there, we want you to be making decisions based on a multitude of factors. Those factors are entirely at your discretion. So the recommendation from us is to lay the groundwork, have a foundation for making your decisions, and then adhere to that foundation as much as you can. Beyond that, in terms of our agenda today, everyone, we will, of course, work through our traditional top-down methodology. We're going to hit up the major indices. We're going to explore some sector moves today as well. We're going to talk about a lot of the groups that are on the move following the rate cut, but maybe more notably than anything, the potential that we may not get a December rate cut, which did seem to cast a bit of a sour note over yesterday's announcement. So with that, let's take a look at what I imagine to be a fair bit of red getting us started this morning, everyone, here in the S&P. As you can see, we're off 0.5%. We do have some red on a number of key areas. And really today, we are going to talk about those relationships and try to bring you back to some of the basic tenets of investing and of the market, understanding the risk on groups, the risk off groups. So we very likely will see some risk off leadership today. If you're going to be getting any active positivity out of the market, it is likely to be from those defensives. Remember, our defensives commonly we think of as perhaps some of our healthcare positions, maybe some in the form of staples, as opposed to the risk on side of things where you're going to see technology leading, you'll see discretionary leading, of course. We've had a good move with those tech, with that discretionary groups as well, but in the midst of short-term news like we got yesterday, perhaps we're apt to see a little bit of a breather. Now, as is often the case, when we've been working so strongly in the S&P 500, note we're well above the 20-day moving average. I'll go ahead and zoom in to essentially the last 6 months here. We are approaching a gap level, so a potential spot for a pause in any selling. Does not mean by any stretch that that's the level that's going to maintain, but we should make note of it. The low of the gap here when we moved higher on Monday was 68.44 approximately. And there's nothing wrong with just making it really simple on ourselves, just going in and adjusting these levels to exactly where you want to be. So 68.44 essentially our low on that gap. We can put that line in, and then when we navigate through our intra-period charts, that line appears for us as well. So here I'm looking at a 2-day 15-minute. We can kick that back to a 1-hour bar, and the same lines that I had on my daily chart are applicable here. So what happens from a trader standpoint? You look at this big zone. I think a lot of technicians would tell you, hey, if we slipped through that white line into this rectangle, we have as much likelihood of getting to the bottom of that gap as we do of doing anything else. And so where would maybe a trader look for the selling to take a pause? Perhaps it's at that bottom of the gap, something like that, which would be about 68.10. Again, we're not suggesting that that's what's going to happen, but as a trader, if you're giving thought to how things are moving and you see where we reside, we would apply some importance to those gap levels for potential zones of support or resistance. Now, I know that's hard, especially in the moment when you're watching things stay red. Especially for some of us who've been watching the market continue to make this assault higher, continue to digest negative news in a positive way, and push prices to the upside. It can be really difficult to believe that the selling can continue. But knowing what we know today, knowing the potential for shifts in policy as we go forward into the end of the year, this conversation out of the Fed yesterday, out of Jerome Powell, did kind of put a little different spin on things. So traders have to at least give consideration to the potential that we're not going to get another rate cut. And that's what the market, I think, is heavily reacting to, in addition to any of these catalyst opportunities from individual equities reporting on an overnight basis. We'll look at some of those today as well, obviously. So as you can see, if I zoomed in, we are in the midst of slipping through that ledge right now. We may very well see a little bit more selling in the early portion of the session before we get any type of a hold or a bounce in here. So be considerate of your levels, any levels that you may have set for yourselves. Make certain that we adhere to those. Of course, as always, when we plan our process, when we plan our trade, the whole reason for doing it is so that we can take action in the moment. So if you've spent the time developing a plan along the way, and now your plan is working its way out, it's important to stick to it. Okay, so follow your plan. As we often say, you build a plan and then you trade that plan. So try to stick to it as best you can and work with what you've laid out for yourself. That's the whole process that we want to undertake. All right, so the S&P slipping a little more. We're off about 0.75% further than we were off the jump. So let's see how the NASDAQ 100 is reacting. We're getting similar price action here. Continued move to the upside look great. We can obviously draw that same similar ledge at the gap level here. Some would put in another ledge down beneath at the former highs that we'd had. So we've got a couple of banners of support here in the NDX as well. And then from the trade standpoint, everybody, remember, some of you would choose to just stay long because you haven't broken the broad trend. Those traders have to admit, though, that they're comfortable with the pullback to the levels before they would make any changes. So for some of you, you'd say, yeah, I can handle a pullback all the way to this secondary white line, but a close below that secondary white line, maybe that's where I'll lighten up. And again, having those levels and admitting that you're comfortable to allow the position you maintain today to carry you lower, that's a big part of that process. Make certain that you have evaluated levels below your comfort zone. I think that that's an important aspect for many of us. Be setting levels below comfort for the purpose of making certain that we can stick with moves beyond our comfort levels. And a lot of the time that means you're going to need to position yourself properly on the side, right? You're going to be either building more cash or reducing position size as we go about that process. So having that ongoing conversation with ourselves is very, very important. Okay, now on the intra-period basis, those same lines I've drawn in so far maintained. On the 1 hour chart, you can see the level to which we have fallen here, which is S2. So we gapped S1 on our pivot points. So that presents as a pretty important level of resistance. And make note of that perhaps on the NASDAQ basis. But everybody, the fact that we've gapped S1 on our open today means that S1 could act as our intraday pivot point. Very important level for intra-period traders. Not necessarily strong in terms of resistance, but for intraday traders, anyone willing to buy up a bottom, let's say we get a little bit of a hold in here at S2, the secondary green ledge. If we get that to hold, some traders would expect a rally back into that green line, but that could end up being the majority, if not the entirety, of any bounce. So this level becomes important on an intraday basis. We don't even know if we're going to revisit it, given the weakness we're experiencing at the open. But I think that gives us at least something in the intermediate or the very short term, rather, to be monitoring on the NASDAQ 100. The Russell showing surprisingly here today, we are actually a little relative strength out of the Russell. This is not what I would have expected today, given the news that we've covered here as it relates to the FOMC and the expectation going forward. Again, his indication, Jerome Powell's indication that the central bank may not cut rates again in 2025 was really what I noted as being the sell-off factor, the sell-off note, if you will. So seeing that it played out that way thus far, I'm kind of intrigued by the fact that we're holding up. I'm going to eliminate my oval real quick, and you'll notice that our lows today are coincident with yesterday's lows. Way too early to say that everything is okay. I think many traders would expect perhaps the 50-day to continue providing perhaps the best amount of support. Some traders would suggest that you've got a nice bit of confluence at the breakout level on the 50-day now. So you know what? If nothing else, one way to look at this, let's just draw a line from the 50-day ledge, which is at 24.31 or so, down to the 200-day. And if a trader thought that it could, if the 50-day were to break, that we could revisit the 200-day, well, then you have to be participating in a 9% drawdown from there. So do the math on that if you're the owner of such an index, right? Take a look at where could support fall if, in fact, we retreated fully to the 200-day moving average. And again, that's simply because you break one moving average, some traders expect the next intermediate time frame or the next leg of the moving average to provide some support. That's where the 9% and the 200-day come into play. Now, if you're not a 200-day moving average, if you're not a concerned trader in that regard, you could look back to the area from which we've really broken higher, and that was when we took out this ledge right here. So it could be said that there could be some horizontal support in this vicinity at this ballpark, 2310 or so. And if that were the case, it's a much lighter pullback, only in the neighborhood of about 5% through the 50-day down to that ledge around 2315. So, hey, that gives you something to eyeball. It gives you something to set risk against if you believe in those levels or those trends that we're seeing here. But again, I've said on many occasions, everyone, the key, I think one of the key factors to managing our positions is to be reminded that if you're feeling uncomfortable, it is perfectly fine to build cash. You can be bearish simply through building cash and maintaining a larger cash balance on your portfolio. You don't have to take positions that are going against the broad market, right? You don't have to own inverse positions to the market or anything like that. You can absolutely just build cash and become more comfortable with a large balance, and then look to deploy when opportunities for bullish trades kind of show themselves, right? You don't have to be as active as you might be when we notice the market undergoing these swings. Sometimes traders just pull back, sit on their hands a little bit, let the market do what it's going to do. And you know what? If this is one of your first forays into maybe a little bit of more volatility or a market that's not as clear to analyze, then building cash will give you more comfort, okay? Not everyone is going to be comfortable trading both sides of the market 100% of the time. So please be aware of that as well. All right, let's look at our semis. And you're right, everybody, we are getting a little bit of an intra-morning bounce quickly. You're right. Let's talk about, before we get to the semis, let's just hit the VIX up here real quick. VIX already weakening, so it was elevated here this morning a little bit, but boy, it looks like the majority of traders pulling back a little bit on their hedges at this point. Does not seem to be a factor in terms of the maybe the fear going forward in the SPX right now. So we'll see if that continues. But right now, breathing a little, at least on the VIX. So, okay. And of course, as you get the breathing in the VIX, you'll notice that we're all higher than we have been at our lows today. So off the lows, we'll take that as an initial positive here. Let's look at our semis. Doing more of the same. We really have no complaints about the semiconductors. You've been trailing that 20-day moving average in orange since we broke out here early September. So right now you're looking at nearly more than 6 weeks, almost 7. More than 7 and almost 8 full weeks of rallying, utilizing the 20-day moving average as support. We have extended above it. We do have a divergence here with our lower high in the RSI, and many of you know that lower high in the RSI is not a signal for a reversal necessarily, but rather for potentially a pause. And then the last pause we underwent last only about 3 weeks or so, October 2 until we broke it here, October 24, and then continued move higher. So a couple of levels for y'all here. Prior highs coincident with the 20-day could provide support in the shorter term. A breakthrough there, go back to prior highs coincident with potentially the 50-day. So you've got a couple of levels there as well that could be offering support, offering areas under which traders take action. Again, some key components to trading it. Don't try to overdo it, right? We don't want to be necessarily a seller at support. We would like to be a seller before we test support so we can capitalize on some of that upward momentum, right? So if you sell a little up here, it can give you more comfort to maintain a position down to this level. And then if you take out this level at the first white line and the 20-day moving average on a closing basis, some traders would then say, all right, now we've got evidence of continued weakness, evidence that might lead to more selling. And again, when I say things like may or might, ultimately what I'm suggesting is that we assign a likelihood of that potentially occurring. Again, it's about probabilities, never certainties. So if we take the SOX under the 20-day moving average for the first time in 2 months, well, then our probabilities increase for an instance of a deeper drawdown. Whereas if we simply held the 20-day, many traders would say our probabilities for continued move higher are greater rather than selling lower, right? So again, no one's suggesting that technicals are going to tell you what's going to occur next, but they are going to give you a lean one direction or the other. Sometimes that lean is fairly limited, 50-50 shot and then a close below the 20-day. Now you're thinking, all right, 51% more downside and maybe 49% upside, right? It can be very, very limited in scope, but our job as the trader is to manage our positions so that we can make those decisions pretty quickly and live and in the moment without what I hope to be without emotion for you all, right? So, okay, so semis, fine at this point. The fact that we're off our lows, look at what did we test? The gap ledge, and now we're moving higher. Maybe there's a little bit more optimism here this morning than we expected. We'll see. All right, now we talked about the Russell, which has managed to flip green here. That could be a positive development for us. Let's look at how it relates to the 10-year. So, as I noted, Mr. Powell suggested that there was a bit of back and forth over whether we were going to get a quarter-point adjustment this month, as it turns out. That many traders out there thought that this was, in fact, a foregone conclusion, and so much so that we'd had the likelihood of a cut at about 97, 98% heading into yesterday, everyone. And yet, the commentary thereafter was, hey, be prepared. December may not bring us a rate cut. And that really did kind of spook the market. And so what have we got? We've got yields rallying a little bit on perhaps the potential that we are not going to get that next cut. Now, in fact, let's go ahead and pull up the third-party CME Fed Tool website page. I'm just going to scroll down the screen here, highlighting the December window. We are now at 69% likelihood. Early yesterday or late, right or after the change yesterday, this was around 55% or so. Look at the difference on a one-day basis or 1 week basis. Last week it was 91% is how traders were positioning for a cut in December. Today it's down to 69. So there's been a very large adjustment based on yesterday's conversation from the Fed. So we got to keep an eye on that. And I'll remind you once more, these are just how traders are positioned. It's already popped back a little bit. And again, that's likely due to what traders are thinking about in terms of data, right? If the Fed is going to remain data dependent, then traders may very well be believing that the data will show that they have a reason to make that cut come December. Whereas as of yesterday, that wasn't the belief out of Fed Chair Powell. And of course, beyond that, we know that we're still in government shutdown window, which means many traders are wondering, can we believe in any of the information or any of the data with which the Fed is making these decisions? And to that, I can only say, I don't really know, to be quite honest. So the market is going to tell us quite a bit in the next, say, 2 months. Hopefully, we get some resolution on the government shutdown, and then we can start at least getting data that can be relied upon a little more clearly. Okay, so there's a look at your rate situation as it relates to the Russell. This is a pretty good spot for a rejection, everybody, because we noted that we've been below that 50-day on yields for a while, and then that's been resistance for us. So let's keep an eye on that if we're watching the trend here. Saw some of you asking, hey, Kev, what about Dow theory? Let's take a look there. Sure, you got it. Dow theory utilizing maybe the more current market viewpoint. What I mean by that is evaluating the SPX and the semiconductor index, those two being essentially the drivers of the overall market. You know, Dow theory is stated to work with long-term viewpoints, right? Dow Jones Industrial Average versus the Dow Jones Transports. And we'll get to that momentarily, but the reason that I throw this up with the SPX and the semis is because those are the groups that are most monitored and most watched today. The market in 2025 differs quite a bit from the market in 1900. The 1900 market was one heavily developed in making items, making widgets, and moving cross country. We are no longer a production country, haven't been for some time. We are absolutely a consumption country, which is why you see things like discretionary continuing to lead in many cases when we talk from a sector basis. So if you're thinking about the market in a new way, then some traders would look at the S&P and the semis and suggest that both making new highs in concert validates the trend. Does that mean we aren't due for a bit of a breather? Well, I mean, the extent to which we've seen these groups move could suggest that we are due for a bit of a pause, right? I mean, the speedy move to the upside here is substantial. If we looked at just from the breakout, when we could really say things were moving, everybody, that's 24% over 7 weeks. So that is a very steep move, okay? Does not mean it can't continue, but it's getting to a point where traders are going to be wondering, shouldn't we be getting something like this over the coming 2, 3, 6, 8 weeks so that we can at least digest the enormous move to the upside? Many traders would say yes. That doesn't mean it's going to happen, but that's what traders might be looking for. All right, let's peek at this based on more traditional scenario: Dow Jones Industrials, Dow Jones Transports. And here, this is where you're getting a bit of a divergence between the two. Industrial average making all-time highs, bullish. Transports, not making all-time highs. That does not mean that the transports won't get in gear, but it does let us know that there is a level above which we must get the transports to trade. And that appears to be the 16,250 approximation, coincident with my white line there. Okay, so that's the level that some traders are looking for. Remember, the main reason for that, look, we had a beautiful uptrend working. That's what my red line is defining, is this long range uptrend. I'll give you a clearer picture on that here. Let me maximize my sell, and I'll add some time to this just to give you the visual. We'll go 20 years here. Yeah, see? So you had a lovely uptrend working from the 2022 bottom after a fantastic move, right, in transports. So we found support, built a new uptrend. Uptrend got broken. Uptrend line was support. Now uptrend line can be resistance. Well, that's exactly what happened here. And that's why this white ledge at 16,200, 16,250, somewhere in there is a very important detail for us, right? Very important that we get this group back above that level, because if that were to occur, then we'd have that validation that, hey, what's going on with the industrials may be happening with the transports, and that would be very beneficial. So we'll see if it plays that way. Right now, it remains to be seen, but you could take today's action a little bit positively. Let's kick this back to a 3 years. Go. All right, so there's your Dow theory look at things briefly, everyone. Let's kick it back to our main review. Let's hit up the sectors now today. So I noted off the jump some of the understanding of how markets will move when we have this so-called risk-off feel to things. Well, we're getting a little bit of a sell there in your tech. You're getting a little bit of a sell in your communications. You're getting a sell out of your discretionary. We know that there are companies in these groups that are doing that for us. So we're going to look at those momentarily. But groups on the bounce today, we're getting financials making a move. Okay, now that's a good move, not a trend move just yet. As you can see, we've really been in consolidation mode on the financials for a few months here now. So this bears watching. As long as we maintain that range, it gets intriguing when we get outside of that range. So for now, notable, hey, let's see what happens when we get above or below the levels there. Healthcare with a little bit of a move. Interesting spot being at the 20-day. Obviously, bulls want to see that held up at the 20-day. Potential for the last ledge of support to come into play if we don't. From the standpoint that shocks me a little bit, it's the staples not getting the pop here at all today. This would be perhaps the area that you might expect to see the money flowing into today from the standpoint, once again, traders. Now, I say things like, hey, it's okay to build cash. It's okay to move out of your risk on and build cash, maintain cash, look for your next opportunity. A lot of traders, however, immediately flip that balance around. They sell out of discretionary with the intent of buying staples. That's not what's happening just yet today. In fact, they tried to buy it, right? We had a little bit of a rally in staples there with that tail today. But this actually, I think, from a structure of the market and the reaction of the market standpoint, I think traders would tell you that this is a positive as it relates to the risk-on viewpoint. If staples aren't going to rally when given the chance, well, then maybe the enthusiasm for risk, technology, and risk-on viewpoints, risk-on areas of the market provide a better opportunity still. And that's a good thing, because if there's comfort with taking risk, well, then you would expect that traders are continuing to look bullishly, continuing to take out those opportunities. So yeah, staples trading essentially near lows, while the areas we would prefer to see getting that foothold are showing some of that performance, some of that relative strength here today. So transports continuing up, SOX turning positive, Russell carrying from negative to positive. That's already a 1% plus flip on the Russell 2000. So we're going to see here to what extent that changes. Some really good questions here in the queue. I noted, thank you, Brent, for highlighting some of the transport companies you might be familiar with. This, of course, is going to incorporate your truckers, your airlines, your Ubers and Lyfts, and rail. Don't forget rail stocks here as well in the transports there as a group as well. I think we had a report on one of those transport companies, but I don't have the headline on it. Well, we're going to look at it here. Let's just see if I'm right. I'm going to open up my news, and I think Old Dominion, ODFL, had a report. Yeah, they sure did here. Yeah, just yesterday before market, and yet you're not getting any positivity out of that trucker, everyone. They shares jumped as Q3 earnings were positive, topping estimates and expectations, but their freight slowdown, to me, that speaks a bit. That's a pretty ugly downtrend. What you want to see is a downtrend that obviously reverses course at some point, but there's a trucker that has not gotten itself properly reversed just yet. So let's look through some of these, some of those companies you're familiar with, your airlines and so forth. In fact, let's do that real quickly. Let's hit up our air. So here's your total stock market for the airline index. A bit under some underperformance here in the last couple of months, right? Just moving sideways. Had a lovely uptrend working, broke it. Nobody should be surprised that we didn't get back up above that, right? Because that line was pretty strong and stout for about 6 months there, from April until the end of September almost. So that seems kind of notable on the airlines. Let's look at those ride shares. So here's Uber maintaining a trend right at the 50-20 confluence as we speak, possibly considered support in that area. What about Lyft? Maybe from a chart structure standpoint, that looks a little more appropriate for some of you. Bouncing back to the 50-day, holding it. That at least gives some traders some comfort with the idea that, hey, maybe a close below the 50-day would be reason to move on. Might be a little early, obviously, in the day today. If you're looking from a bullishness standpoint, some traders might say, yeah, once we take out that downtrend line, I'll be intrigued. So that gives you a ballpark over about 20.5 if you're a trader looking for those. So you can see interestingly enough, it's not like transports are rallying on a number of key details here. Let's look at a couple more in the space here. So FedEx, always one of the earliest to report, and you've seen some relative positivity out of this since their earnings in September. But it has achieved a level that it had not achieved for a while. Some of you might be looking at this action over the last 3 days on FedEx here as being maybe confirmatory in nature. And if that holds, some of you might even turn that white line to a green line in the hopes that it acts as support going forward. Here's how that looks on the weekly chart. You can see it was a pretty good breakdown here. FedEx had been doing just fine, and now that we fell through this level, we're battling it out over this is the 50-week. That should be the 40-week. Let me change my study set here. Let's see. There they are, weeklies. So what do we rally into? The 100-week moving average got tested essentially with this week's move. So maybe that validates that area as resistance. We'll see how that goes on FedEx. And then, like Brent mentioned, there's more than a few here. Let's hit up one that's been a stinker in that transport space had been UPS. Got to bounce right into resistance on their earnings. Great level for a bounce, especially if you're an owner in this consolidation back here between 83 and 89. Some traders are looking to take some off on a bounce into the 200-day, which would make sense from a trend standpoint, right? Let's add a little time to that chart there on UPS. Okay, look at that. If you're looking for a downtrend working against a 200-day moving average, you'd be hard-pressed to find one more consistent. This is a fairly significant level there, right? So knowing that, a lot of traders are going to say, hey, only over 100 on a confirmed close over the 200-day moving average, something like that. Is that going to be where traders maybe shift their viewpoint? Pretty intriguing. I saw somebody else asking about Boeing earlier. We're talking transports. Why not? Yuck. Sorry, everybody. That is not what you're looking for. Let's zoom in on that, make it a 1 year. So we're going to go back to standard technical 101 stuff, everybody. Look at that. 50-day moving average. Oh, it's so beautiful. Right in there. Support, support, support. Uh-oh, we broke it. Resistance, resistance. So what do we expect? Well, we've made a short-term lower low. We don't know if it can maintain this ledge. This could be a level of support, I suppose. Oops. And if not, then why not just automatically call out the 200-day? It's really close. So this level's about 204. The 200-day is about 4 points lower, maybe 5 points lower, right? Good point, Jay. Yeah, maybe you incorporate the Horner rule on that UPS chart, right? Remember, it is 3 days. That's not mine. My rule is have a rule, right? Define confirmation. That's what we're looking for. Here, these are great reminders too. We had Boeing a day above the 50-day and then immediately below. 2 days above the 50-day and then immediately below. Remember, don't assign narrative to why it came back below it, but the fact that it did come back below it. And then further, remember that when you're watching these moves, what once was support becomes resistance when we break them. So this is not uncommon. Doesn't mean it was easy to know in the moment, but if you've seen this play out multiple times in the wild, well, you're going to be a little bit more prepared for it. So I had to make sure we're looking at that on Boeing as well. Let's get to some of these other companies that I know many of you were wondering about. So let's look at, and by the way, since I'm talking Boeing, let me give you as well a downgrade out of Deutsche Bank today. They downgraded it to hold from buy. Target on this at 240, down from 255 previously. The firm cut its free cash flow estimates through the 2028 calendar year following the earnings report. And so they basically cut those cash flow estimates by more than 50%. Not a real great sign. So continued move lower, 3 red candles in a row. That's, needless to say, less than ideal. Hey, everybody, we do have a survey link in the chat. Always love hearing from you. If you take a moment to just give a score, no problem at all. If you'd like to leave your comments, equally great. All those comments, anytime you leave them, they come directly to us hosts, so we'd be happy to hear from you. If you're going to take the time to post those comments, I'll take the time to read them for you. Okay, how about the big guys? So we heard from Meta yesterday. We mentioned the communication space moving lower. Well, obviously, communications isn't likely to go lower unless Meta is going lower. And you can see a pretty significant development here. We're off about 11.5%. We didn't just break the 50-day. We didn't just break the 20-day. We have broken the 200-day, and we have done so with a fair bit of conviction. Notice the volume here today, everyone, already. The last 2 days' volume, pretty substantial. And when you're looking at it from a standpoint of relative to prior price action or prior volume levels, it is significant. Why is it significant? Well, we have to consider average volume all the time. At least I encourage us to do so. So we'll put in the average volume line here. Make sure that I assign that in my volume pane by moving it up to the volume pane, hit apply. And then I bring it up because I have to remind ourselves when we get volume that is in excess of the average vol, the 50-day average volume line, it is not you and me moving that volume. That is institutional traders, in this case, unloading positions, right? They are moving out of Meta today. That doesn't mean it's not a level that Meta could bounce from. It just means that institutional traders are unwinding larger positions at this point. That's what we can take today's volume to tell us. Now, it will be significant, a positive perhaps, if the week open resulted in a huge hammer candle, a green hammer candle that could get you back above the 200-day, but that is a ways off, right? So I hope that makes some sense for us. So on the heels of their announcements, Oppenheimer analysts downgraded Meta to perform from outperform. They did not apply a price target. Heads up there. Benchmark downgraded Meta to hold from buy. They removed their prior price target. Meta is certainly pursuing AI investments beyond advertisements, but returns are less certain, according to Benchmark, and hence their downgrade on Meta. So needless to say, Meta is having a pretty difficult impact on the communication space, though, here. So let's move off of Meta and let's check out another in the same space. We'll hit up Alphabet, which is doing the opposite. Now, Alphabet's chart had a good open, but a good gap low, and then a gap higher, and then just continued to run a little bit there. I wonder if. Okay, so I'm going to call this a bad low. I don't imagine. Maybe that's. Let's see. Yeah, that looks like a bad tick. So maybe you throw this one out, but it's impacting your daily candle right now. It should be a little bit higher, more likely 280 intraday there. Alphabet, though, the commentary here, YouTube is organizing its leadership team. They are expecting commencing a voluntary exit program. So looking to the future, they believe the next frontier for YouTube is artificial intelligence. It has the potential to transform every part of their platform, and they want to set themselves up to make the most of that opportunity. So that seems interesting. Jefferies raised the firm's target on Alphabet up to 320. That is from 285. They maintain a buy rating. Wolf Research raised the target on Alphabet to 350 from 290, keeping an outperform rating. Bank of America raised the target to 335 from 280. So you're getting a lot of positivity associated with Alphabet's report. And it seems like the balance between Alphabet and Meta is why you're getting the push and pull that's kind of flattening the communication sell-off here this morning. Janelle, the bad tick here, essentially a bad tick is one that occurs outside of the best bid, best offer. Remember, when you're looking at a trade and it's giving you a bid and an ask like we see here, it's obviously it's moving very quickly. 289.98 by 289 289.90 by 290, right? So 10 cent wide. If it happens in between there, that's considered legitimate. But if it happens outside of the best bid, best ask, well, then you get an execution that is valid, but it may not be appropriate relative to, say, executions of limits and or stop orders. So there are some rules about trade activity there, or executions that validate your stops, validate your limits, etc. Those are minor details, but you will occasionally see, when we say bad tick, ultimately what we're talking about is a price that makes its way across the ticker that isn't necessarily considered to be within the range of price action in that window for the candle. So if we're looking at a 5-minute bar and you have that really long wick like that, it kind of defines itself and says, okay, that looks like a trade that went outside of the best bid, best offer within the window of time the candle represents. I hope that makes some sense. You don't see, occasionally we'll get those, not terribly frequently, but occasionally. Okay, final minute here. I was just looking for maybe anything else. Oh, got it. Let's bring up Microsoft. Microsoft also reported, and there's been a bit of selling there in Microsoft. I had a headline here. Okay, Microsoft backed OpenAI, laying the groundwork for a potential IPO that could value the company at up to $1 trillion. According to people familiar with the matter, OpenAI considering filing with securities regulators as soon as the second half of 2026. And in preliminary discussions, the company has looked at raising upwards of $60 billion and potentially even more. Talks are in early stages and plans, including the figures and the timing, all of which can change dependent upon business growth, market conditions, etc. So that is just, again, a headline. That is not necessarily what's absolutely coming. And I think the latter comment there about all could change, including figures, timing, etc., depending on business growth and market conditions. That tells you plenty, right? hey, we'd like to do this, but the market's going to tell us whether or not that's valid. And when we get there, beyond that, we had Bernstein raising the target on Microsoft to 645 from 637. They maintain and outperform. Morgan Stanley raised the target to 650 from 625. They maintain an overweight. Wells Fargo raised the target from 675 to 700, and they keep an overweight as well. All right, we are at time, everybody. Lots on that agenda today. I hope we got something out of it. Thank you all for being here and participating. Remember to follow Brent and me on X, Brent Morris, CS, Kevin Horner, CS. Please take a minute to take advantage of the survey opportunity here in the chat. Love to hear your comments and your feedback. It's always valued by me and the team, so thank you for that. Don't forget to subscribe to the channel. And if you liked the conversation here today, hit that thumbs up for me. We're going to get this one completed, reviewed, and into the archive for our other viewers, and that'll help us make certain that it gets to the masses. So thank you all for being here. Have a fantastic Thursday. I look forward to catching up with you again real soon.